Good morning, everybody, and welcome to BDO's Financial and Sustainability Reporting Update for 30th of June 2025. My name is Dean Ardern. I'm one of the partners in the IFRS and Corporate Reporting team at BDO. Today I'm joined by Kevin Frohbus, also a partner in the IFRS and Corporate Reporting team in BDO. Morning, Kevin. How are you?
Hello, Dean. I'm very well, and yourself? Good to be
I'm
back.
well.
Good to see you.
Yeah,
And yeah,
good.
good to be back in, the world of preparing for a year end.
Yeah, no, it's good to see you too. We don't often see each other. This is probably one of our key opportunities to catch up with each other. Um,
Absolutely, yeah.
Now, I'm going to have to admit, and we possibly have to address that big question in the room: is where's the letter? Do you want to
Leslie's
respond?
overseas at the moment, attending one of BDO's global conferences, and she has left this in our capable hands. Hopefully, we can rise to the occasion, Dean, and not disappoint a letter. But she will be back next month as per normal.
I'm yes, I'm feeling the weight of expectation on me at this point in time, so I'll be trying to do the best I possibly can.
We'll be fine.
So, on that note, why don't we press on? Um, You've met us. First, we'd like to start by obviously acknowledging the traditional owners of the land on which we meet today and pay our respects to elders past and present. And we extend that respect to the Aboriginal and Torres Strait Islanders peoples here today. For me in Melbourne, the traditional owners are the Wurundjeri Woiwurrung and the Bunurong Woon Wurrung peoples. I think for Kevin in Sydney, the traditional owners are the Gadigal people. I think that's correct. Excellent. Um, just a quick update on our webinar program coming up for the rest of the year. So today's obviously the financial and sustainability reporting update. We've got another 7 webinars to go after this one. There will be quite a bit of the material today will actually be, we'll cover areas which we will cover in more detail in future webinars, and I'll actually note of those webinars when they, those topics when they come up, I'll actually notify them of those. Probably the key ones, obviously, today that we're probably going to be useful going forward would be things like particularly tricks and traps for impairment testing. That's certainly one's going to be quite relevant to entities going forward. Kevin, did you want to talk to the sustainability webinars?
Yeah. So as you'll know, as everybody online will know, reporting or mandatory reporting is also moving into the world of sustainability, or in particular, climate reporting as a mandatory report. It's the regime is kicked in the through the Corporations Act this year, and is already effective. It's also rolling out through the public sector through a different reporting regime, but it's roughly the same thing, which is basically climate-related financial disclosures. As a result, we have a parallel series of sustainability webinars that focuses on the steps to preparing for mandatory climate reporting. 4 of those have already been done this year, and Alette's leading those. So the way we're kind of focusing them this year, we're actually getting into the nitty gritty of the 4 pillars: governance, risks and strategy, risk management, and then metrics and targets, which includes things like carbon footprint. Next one up on the 28th of May, and Aletta will be back for that one, is the strategy section. So that's climate resilience and the effects on the financial statements. So we're talking about things like scenario analysis and how that leads through to financial modeling. And I will come back to some of those concepts later on in this session, and hope to see you, at some of those webinars as they progress during the year.
Mm, thanks, Kevin. Um, the other thing I'll get you to talk to, Kevin, is the
Oh,
carbon
Carbon Master.
masterclass.
Yeah, sorry, I kind of forgot about that. So, one of the first steps you would do in doing your climate reporting or preparing for climate reporting is carbon emissions calculations, and in particular for your first year of reporting, your boundary setting as well as your scope 1 and 2 measurement would not only need to be disclosed in the first year, but also subject to limited assurance by your auditor. So it's a big one. And as a result of that, we've been running a series of carbon accounting masterclass. I think this is third wave of those masterclasses. So we've done sort of three waves across the country over the last two years, and we're into a series of virtual ones now. I actually think the next one is in 2 weeks. It's the 4th of June, which is the one on the
Mm,
slide there. So this is virtual, it's online. and you can register for that. And we are doing a series of those through to the end of the year because it turns out a lot of organizations are just standing up their carbon measurement. I would put a little bit of a plug while we have the opportunity in the sense that even if you're measuring carbon currently for, let's say, target setting or some other type of purpose, um, it might be worthwhile tapping into this masterclass to check your understanding about how your current calculations, if you have them, actually need to be adjusted to meet with the requirements of the mandatory reporting regime. The standards and the requirements are somewhat different. And so even if you think you've got carbon measurement currently, taken care of and you're measuring scope 1 and 2, and you might even be measuring things like business travel and employee commuting carbon emissions, you may just want to take a step back and make sure, one, you've aligned your reporting with the standards so that you're actually reporting under the right framework, and then also preparing for being assurance ready, because you're going to actually have to have that assured by your auditor. So take advantage of this. 3 to go for the rest of the for the calendar year. Please register now at the link.
Thanks, Kevin. Quick look at today's agenda. So today we're going to kick off with an ASIC update. There's a fair bit going on in ASIC, so it's a very timely topic to cover. Changes to public company SEDS, Pillar 2 top-up income taxes. We're going to look sort of more broadly at accounting in times of uncertainty, obviously with the prospect of a different tariff regime going across the world at the moment. That's changed a lot of things and a lot of expectations around performance going forward. Standards applicable for the first time 30th of June 2025. Interesting, it's not a lot of standards that are new, but I actually think that there's quite a broad group that has the capacity to pick, that entities might find themselves actually within and not knowing it. So I think it's worthwhile actually really focusing on a couple of these ones. One in particular that in terms of the non-current classification of liabilities is going to have implications, I think, for lots of entities and does apply right across the board. A quick look at recent IFRIC agendas decisions and sustainability upgrade. Kevin?
Yeah, I just want to kind of make a note. This is a 90-minute session today, and that's traditionally normally the case when we're doing preparing for a financial reporting period like June 25. We normally do 90 minutes. And the other point to make is the sustainability update, once again, will return to some of these things that we're talking about. Try not to see the IFRS side and the sustainability as separate. They're actually linked, because just for context, in a lot of what we'll talk about today is the mandatory climate report is actually required to be in the annual report along with the financial statements, and there actually is a financial link that the two will intersect. So please look at today as not two sections, but actually one integrated conversation. The earlier you start to see it that way, the better, I think, in terms of preparedness. And Dean, I'll hand it over to you to kick it off.
Yeah, fair point, Kevin. That's a really good one. One more bit of housekeeping I was going to mention. If you have questions, happy for you to drop them in the chat as and when you think of them. We will try and address them as and when we can. And if we can't, we'll either do it at the end or we'll send you an email following the webinar. So let's start with ASIC update. Now, interestingly, last year, ASIC announced that they were segregating their areas of focus into enduring areas of focus and then other areas. So other areas may be topical year by year. Interestingly, this year, they started out last year with the impairment provisions, post-balance date events, and financial report and operating and financial review disclosures. Now, this year, they've actually, it appears that they've added revenue recognition. Now, that's not surprising on the basis that it's a relatively common topic area for ASIC when they talk to entities about their financial reporting. They've sort of added it to the enduring areas of focus. They haven't sort of gone into detail on it. But certainly from my experience, the kinds of things that ASIC would be looking at in the context of revenue recognition are fundamentally your position in terms of your performance obligations and then understanding the timing of those, completion of those performance obligations and therefore the recognition of income. So at a very high level, ASIC's always focusing on timing and amount of revenue, but now they're drilling a lot more closely into that performance obligation aspect to it and articulating those performance obligations, making sure that your timing of your revenue aligns with those as and when you complete them, and then the amount is actually relevant and justifiable in context of the transaction price. Kevin, did you want to add anything to that? Because I think that's like that's been one of the key areas that ASIC has been really focused on, I think, for the last 2 years.
Yeah, look, no, I think you've nailed it. I mean, now that you invited me to make a comment, I probably will. But it's just I have this really strong passion that um, the standards that best interact with the actual business reality happen to be the ones that are at the top of ASIC's list. Everyone thinks accounting standards don't reflect reality and perhaps maybe don't align with what's happening in the business, but believe me, when you do them right, they actually
Mm,
do. And I
mm.
think in terms of how revenue interacts with actual commercial reality of the underlying contracts, and then impairment, which we're going to talk about a lot today, actually reflecting the reality of not only the economic environment, but also the decisions you've made as a business, really start to kind of bring it all together. And I think there's no it's no surprise that ASIC focuses on there because that's where a lot of the key information pops out in terms of investor information and really the reality of what's going on. I'll leave it at that.
Yeah, no, they're really good points because fundamentally revenue touches everything. Like you think about it as a top line item, but it actually flows right through the entity in terms of budgets. It flows through in terms of KMP remuneration. Like it hits every aspect. Impairment testing, it hits every aspect. So timing and amount is fundamental. Interestingly, I'm doing a bit of work with a couple of clients at the moment that are looking to restate some around some of the aspects of their revenue and looking at those again. And again, it's that issue that no longer that they believe that what they're doing is actually necessarily consistent with their business model. Their model has moved on. Now they're actually reconsidering what they should be doing. And so that's a very, very natural thing. That's actually a really important thing too. Revenue is not set and forget. You need to consider how your business model, if and how it's changed, and if and how perhaps you need to modify your revenue recognition to reflect that. Impairment and asset values is always an area that ASIC always looking at. I've a couple of dot points there. Asset type, obviously, asset type can drive the nature and the timing of the impairment testing and the impairment type of impairment testing you do. ASIC made that pretty clear in their media release there, the 24174 on inventory. I mentioned before that we've got a BDO webinar coming up later this year on impairment testing, and so it'd be the kind of things I'd recommend if you do have some issues with impairment testing. Really recommend that you attend those webinars. Provisions are an interesting one. The one that we do see a lot of, and entities restating around, are lease made goods. Now, the interesting thing is that now, because leases are on the balance sheet, they're a very visible asset and liability. And so the next question, I think that any kind of, if I was an ASIC analyst and I was sitting there looking at a set of financials and I could see a big old, right of use asset and a lease liability sitting there, the next question I'd have is, what's your provisions? Now, I don't know if you need provisions, but my question would be, do you have provisions? And so if you don't have provisions and you've got material lease balances on your financial statements, that's an area that you should expect that ASIC would question you on. Onerous contracts is a bit of a sleepy one, but the standard doesn't necessarily require an active expectation around reassessing your contracts. But in the current environment, I really would expect entities would be looking at their customer contracts particularly and seeing whether or not they are actually onerous, and then making proper provisions for those if that's the case. Restructuring is also something that entities might be looking at the moment, and it's really important to be cognizant of the requirements in the standard. So there's a different set of recognition criteria, so the timing around restructuring obligations can differ, subject to the way it's done and subject to the types of things that's affected. So be cognizant. It's not just a provision that you said, well, when I've actually decided and when we've actually gone through the process and we're actually going to book it. No, you might find that the recognition of the provision is earlier, and therefore there might be an expectation to see numbers there on the balance sheet a lot earlier. Post-balance date events, obviously the key part of that is obviously remembering, does that post-balance date event affect something as at the reporting date? So does it reflect a condition that exists at the reporting date? Now, if it doesn't reflect a condition existing at the reporting date, then likely it's not going to be an adjusting event, but you need to go through that process and ask the questions. And disclosures, one of the ones that we do see pop up, usually it's after balance date where maybe a legal issue might arise, entities having to consider whether or not they need to provision for the possibility of a legal case or for a legal decision. We do often see the seriously prejudicial conditions met, but it's important to understand that there's certain disclosures around those as well. And so if you don't make those disclosures, then arguably you're not compliant with IFRS in those circumstances. Last one, OFR, we always see ASIC talking about OFR. We always see them asking questions of entities about OFR and their disclosures. It's a perennial area. I reckon it's one of the ones that, to your point you made before, Kevin, it's a really important one about the whole holistic view where you actually don't treat IFRS and sustainability as separate. You actually have to think of them as together. And when you think about them together, it should be reflective in your OFR. I don't know, did you want to say something on that?
Yeah, it's kind of been my motto for the last 4 years, which is ASIC started to highlight the OFR as a way of bringing risks to the fore. Now, I know this doesn't apply to all organizations. Listed companies in particular will be familiar with the OFR, but the idea of it was if you understand your business risks and you can articulate it in a summarized version in your financial report, then you'll be able to articulate your climate risks when you get to sustainability reporting in a really easy way. Because at the end of the day, they're all business risks that impact your financial performance and your prospects. So I've always seen the OFR as a precursor to get your house in order, because when sustainability comes, you can then start to talk about them almost interchangeably. And that is it. It does surprise me that the biggest thing that entities struggle with is they argue and they get very excited about recognizing assets and liabilities on the balance sheet like revenue and impairment, but then they can't articulate their story to their investors, and that's what the OFR is about. It's actually just telling the story, and actually bringing those strategic and business risks out in a concise manner in the public domain for your investors. That's it.
No, good. No, spot on. Other areas that ASIC have identified, registratable superannuation entities, so your large superannuation entities, APRA-regulated ones, they have indicated in their most recent media release on their areas of focus for this year is that they're planning to review half of all lodged financial reports of registrable superannuation entities, and they're going to do 5 RSE audit file reviews. So they're certainly getting out amongst those things. And it's interesting because the entities themselves have had a couple of years where they've been able to bed down their reporting under the new accounting standard, or relatively new accounting standard for superannuation plans, but they're obviously undergoing significant changes in more recent times where they're obviously caught now by the Corporations Act. They have certain obligations under the Corporations Act, and so their reporting is a lot more detailed. Obviously, one of the key ones is the remuneration report, which is obviously really interesting and probably a quite telling sort of report as far as the superannuation entities are concerned. Previously, again, grandfathered large proprietary limited companies is always an issue. ASIC is always chasing those down to make sure that they're lodging and they're lodging correctly. So if they're required to lodge, that they're preparing general purpose financial statements. And typically you would see them doing tier 2, but if they're required to do tier 1, then they'd need to do that. Sustainability report, I don't know if you, Kevin, want to say anything further on that.
Only to say that it's big, it's happening, and ASIC have issued a regulatory guide to 80 as I wanted to say it was a couple of weeks ago, but it looks like it was in March. So funny how time moves along. And it is a good start if you want to apprise yourself of the Corporations Act or legislative environment that's created this whole thing, as well as ASIC's take on what they're expecting. It's not a roadmap. It's not a roadmap to preparing. It's just more ASIC's interpretation of how they're planning to regulate this and how the legislation is meant to work. But if you haven't actually started to kind of unpack this, it's a great read on a Saturday night, especially for training. But jokes aside, it is probably the ASIC guide in particular is probably the most important regulatory guide in support of sustainability report, at least this half of the calendar year, because it's ASIC's sort of first public intention document. This is what they're planning to do and how they're planning to kind of legislate and monitor this thing. And we've wrapped a lot of that up in a webinar, or we will wrap a lot of that up in a webinar coming, as well as on our website, unpacking that regulatory guide. But we've also then incorporated all of that stuff into our discussion later on in the webinar about sustainability reporting. So that'll be at the back end of this 90 minutes.
Yeah. Thanks, Kevin. So last couple of topics, audit conflicts of interest and consolidated entity disclosure statements. We'll talk about a bit more of those later. The topics lend themselves to something, and I have just talked in this sort of forum before about this issue, but All of those topics, it's interesting, they lend themselves to a discussion around position papers. Now, audit, and I think I've mentioned it in previous webinars on this, like ASIC has been quite out there in terms of discussion about the role of audit position papers, or sorry, accounting position papers, and making sure that entities are thinking about ensuring that they've got a robust process to select, assess, apply and implement accounting standards. Report 799 that was published, I think, last year by ASIC, and they made it very, very clear that they think that position paper is an important part of that process, that it's a really important key, not only a key process, but a key indicator of a strong governance process around your accounting policy choice and application. When I was actually thinking about this slide, I actually then picked up their most recent reporting survey numbers. And as you can see there, obviously there is an alignment between their areas of focus and what they're looking at in terms of questions to entities. But interestingly, when you go dig a bit deeper about those and you sort of set aside the purely disclosure issues, so setting aside the OFR and non-IFRS information and financial report disclosures, you start to move through them and you see impairment asset values, revenue recognition, share-based payments, group accounting, which could be business combinations or restructurings, and lease accounting. When you go through those, they're probably, well, from my perspective and certainly my experience, they're the kinds of topics that we find are the most subject to judgment and potentially the most complex financial reporting areas that entities have to deal with. So to me, there's a perfect alignment between the idea that ASIC is looking at complex areas, the areas that they're actually looking at and asking about are those complex areas, and they're the areas that ASIC is probably expecting to see position papers prepared. Position papers are really handy. In other forums, I've actually talked about them over the last couple of months in our corporate reporting insights publications. I've been writing some articles around my experiences with accounting position papers. I've been criticised by some of my team members about using the phrase fanboy of accounting position papers, but I'm happy to wear that moniker, and purely because I think that they're really important. Why do I think they're important? One of the key things, and this is I'm finding at the moment with entities who are looking to maybe reevaluate or reconsider whether or not their accounting reflects what they're actually doing. When we get into the conversation about how they're going to move or where they're going to move to, the first question is, well, how did you get to this position in the first place? Now, if they don't have a basis for that, it's a much more challenging conversation, not just between me and them, but also between them and their client ultimately. Sorry, them and their auditors ultimately, because the auditor is the one that's going to be looking to actually for support from those positions to be able to actually move the entity forward. So we've been on a bit of a journey writing these articles, and we'll continue to write them about position papers, but certainly we're finding that they are becoming as important, if not more important, particularly in environments which are uncertain and a little bit volatile as the current economy is. Kevin, I don't know if you want to add anything further to that? No, all good. So changes to public companies, consolidated disclosures. You'd be aware that from June 30, 2024, all Australian public companies are required to disclose information about the tax status of their subsidiaries in a consolidated entity disclosure statement. So it's a Corporations Act stated statement. Previously, these SEDs were required to state whether each entity was an Australian tax resident, and if not, list each foreign jurisdiction in which the entity was a resident. So the definitions of an Australian resident and a foreign resident in the Income Tax Act were actually previously mutually exclusive, notwithstanding the entities could have actually tax residents in multiple jurisdictions. Also, the definition of the tax residency previously applied to individual and companies only applied to those individuals and companies, so not to partnerships and trusts. So as a way of addressing these obviously shortfalls in the requirements around SEDS, the Income Tax Assessment Act was amended in December 2024 to actually require SEDS to disclose any foreign tax jurisdiction when the entity was a tax resident, even where the entity is also an Australian tax resident, and also to provide guidance to determine the tax residency of a partnership or a trust. It also clarifies an entity would only disclose a foreign tax residency where it is a tax resident for the purposes of that foreign jurisdiction. So you can see what's happening is there was a little bit of a gap in the legislation. It was leading to maybe some gaps in the disclosures in SEDS. And so as a consequence, now you can see SEDS expectation is that SEDS are going to be a little bit more detailed and having to require a little bit more information disclosed. We've provided there a sort of a model look of SEDS as it might appear. And I suppose the key part is there is on the right-hand side, as you look at the screen, the right-hand side there, those two last columns. So you can have scenarios now where you have an Australian tax resident, and you can also be a resident of another jurisdiction. So it's important that those disclosures are made. Within the body of that table also, that the new disclosures, the new requirements in the Income Tax Act, the new definitions, clarify whether or not how trusts and partnerships might fall within the scope of the disclosures. And it is important to remember that because, you know, obviously, in terms of the disclosures, the contents, it relates to entities that are controlled. So companies are one type of entity that can be controlled by another entity, but trusts and partnerships can also be controlled. Oh, sorry, certainly trusts anyway. I suppose I just wanted to dot point some of the things that we'd seen in the last 12 months about how entities are preparing their SEDS, and maybe the important points to note again, just to remind people about what you should be doing when you're preparing your SEDS this year. So public companies that do not have subsidiaries or qualify for the investment entity exemption are still required to prepare a SEDS. So you still have to prepare one, notwithstanding you might not have actually any recognised subsidiaries. Public companies that do not have subsidiaries include a statement confirming that this in their SEDS, so that they do not have. Public companies that qualify for investment entity exemption, so for those that apply that investment entity exemption and carry all their subsidiaries at fair value through P&L, include a statement that Section 295 3A does not apply. SEDS obligations apply to all subsidiaries, including subs to subs, so you've got to be ensure that you're actually looking deep within your own reporting framework to ensure that you're covering all of your subsidiaries. Materiality doesn't apply to SEDS, so immaterial and dormant subs are in. Again, we've probably pushed that button a fair bit in the past, but we wanted to push it again. SEDS is subject to audit. That's part of the annual financial report, so therefore the auditor is required to provide reasonable assurance over the SEDS. An important part is, and some of this is sort of, it works the same way as it does for REM reports. So the SEDS cannot be combined with other notes within the financial report because the directors must make a true and correct declaration, which is in contrast to the true and fair declaration they make in respect to the rest of the financial statements, but they have to make a true and correct declaration in accordance with the SEDS. So for clarity, the SEDS information needs to be actually clearly distinguished so that they actually can make that declaration. But also, ASIC has actually confirmed that that's what they've got to do. So a reminder for those that are preparing SEDS this year, it's important that these are the kind of things that we see. These are the kinds of things that are going to catch you if you make sure that you address them in the process. Pillar 2, unless
Could I
Kevin?
just actually, yeah,
Yeah.
I would actually make this comment. The SIDS is something that I think is probably in my top three things today. It's pretty important. I'm also surprised at how poorly understood it is by directors, the requirement itself. Can I just want to kind of go back to that last point about the true and fair statement of true and correct, sorry, statement. That actually requires a process in the organization that actually makes its way to the board, where the board will actually evaluate that the systems and controls around determining tax residency disclosures have actually been properly affected and have worked to determine the disclosures. It's not sufficient that someone kind of puts a table together and everybody's happy with that. The directors really should be making sure there's a proper control through the audit and risk committee or whatever to make sure this is actually working to actually determine this information. And the reason for it is that determining the tax residency is not as clear as you think it is. There's quite a bit of judgment there, or application of guidance and applicable legislation. And so an operating and control environment around that needs to be operating effectively. The directors need to be across it and take responsibility for it. And the disclosures about judgments made in interpreting the guidance in order to determine tax residency need to actually be disclosed as well. So that's quite a lot of work to be done there, especially in complicated structures. So that is my 2 cents worth.
No, that's fair, absolutely fair point, Kevin. And yeah, I gleamed over that issue about the declaration, but there has to be, as you say, there has to be a whole process behind that to ensure that it's actually a distinct declaration, you know, that they're actually making a clear assessment and a clear declaration based on that criteria, not necessarily the true and fair criteria, which is not applicable in that case. Pillar 2, top-up income taxes. So there's been a fair bit of discussion about the OECD's top-up taxes and how they apply. You're probably aware, if you're involved in obviously any part of this, that this this whole top-up tax arrangement was come in as a consequence of greater transparency around tax payment within countries and companies. There's agreement amongst about 130 plus countries to update their tax systems to ensure the large multinational enterprises pay a minimum of the 15% on income of each jurisdiction in which they operate. So as a consequence of that, we brought in some legislation in Australia, but I suppose the key thing to understand with the top-up taxes is that it works both ways. So you, as a local parent, might be responsible for tax obligations of subsidiaries in other jurisdictions and vice versa. Now, in terms of the application of those requirements, it applies retrospectively. That's the legislation. It applies retrospectively from 1st of January 2024. So income inclusion rules are top-up tax payable by the Australian parent entities of the multinational enterprise groups, where any of their subsidiaries has an effective tax rate of less than 15%, and there's also qualifying domestic minimum top-up tax to top-up tax where Australian member of an M&E group has an effective tax rate of less than 15%. So both works both ways. If you're lodging financials in Australia, then you have to consider, are you the parent or are you a subsidiary of a multinational entity, and therefore what's the tax implications of you? Now, in terms of the accounting for that, thankfully, as a consequence, and it was a very practical response by the standard setters, is to deal with the fact that not all of that legislation that was approved by all those various countries was implemented at the same time. So to deal with that timing issue, then AASB issued on the back of an ISB amending standard, they issued AASB 2023-3. The purpose of which is effectively to introduce a mandatory exemption to accounting for deferred taxes arising from the implementation of Pillar 2. So when we say mandatory exemption, what it's actually saying is you can't apply the standard. It's saying that everyone has to apply and not apply it in the same way. And disclosure of current tax expense or income related to Pillar 2 income taxes in the periods in which the Pillar 2 legislation is effective. One point to note, I suppose, is that contrary to the OECD model rules, the Australian domestic minimum tax calculations are actually be performed based on the M&E Group's consolidated financial statements prepared based on a suite of accounting standards and the presentation currency of the ultimate parent company entity. So it might be a bit different, obviously, to the local entities. In that context, then obviously there has to be adjustments made in terms of those things. Kevin, I'm not sure if you wanted to add anything further to that. Nope.
I'm fine
Very good.
with I'm fine with that, Dean.
Very good. Accounting in times of uncertainty. Here we go. This is more interesting stuff. Certainly the last 12 months, and I reckon even the last 6 months, has been an interesting journey for a lot of entities, particularly those that import and export to various countries. That has triggered a whole lot of publications from entities, but also thoughts around how you actually consider the implications of these things for it. So BDO, like most other firms, issued their IFRB 2025-3, accounting in times of uncertainty, actually specifically looking at the effects of tariffs on financial reporting. Now, sometimes it's easy to think that you don't or you aren't affected by something like discussions around tariffs if all of your work and all of your sales, your goods and services are sold within a country. But when other entities around you are impacted by tariffs, it's going to affect obviously the local economy, but it's also going to affect potentially your competitors as well. And so it might change the way they behave, but it also might change the way that your consumers behave. I've provided there a list of indicators of tariffs that might have impairment implications. So obviously the first couple are pretty self-evident ones. Do you have a significant amount of revenue derived from one or more jurisdictions where tariffs have been imposed on the entity's goods or services? Is there significant uncertainty concerning whether those tariffs will be imposed? Do you have any significant exposure to supply chain stresses, such as increased input costs as a consequence of those imported goods? So again, it might not be that you're selling into jurisdictions that have tariffs, but you might be buying, and as a consequence, you might be paying more for those inputs. Now, the really important part of that comes into the impairment testing process, is how you incorporate those expectations around what may or may not happen into those impairment, especially your value and use calculations, because as a consequence of those, looking forward, your cash flows, you have to think about not only costs, but also revenues. You also have to think about how those costs and revenue changes might interact with each other. So it's important to understand, are you able, if you need to, are you able to pass on those cost increases to your customers in the form of higher prices, or are you stuck with them? And if you're stuck with them, how's that going to impact you? Kevin, I know you're interested in
Yeah.
this area, so I was going to throw to you.
Yeah, look, I think you've kind of touched on where I'm heading, and I think it's going to come up in the next couple of slides in terms of impairment. But I don't really want to jump to the impairment calc first. Kind of want to take us back to how organizations run their businesses. And I am not the person to tell you how to run your business, of course, but it's more about how you stress test your strategy and how you start to respond to these things in terms of your business model implication. And I imagine in order to do that, you would have to have an idea of a range of alternative or conditions and how you put numbers to those things. And that in its raw form is the base input into any impairment model is a range of conditions over the remaining useful life of assets and how you run your business based on, back of the envelope calculations, or maybe there's a sophisticated sort of cash flow modeling thing going on. But at the end of the day, I imagine you're not making decisions in your business based on um, waiting for the news to happen. I think you're kind of factoring these things and starting to get to get organized. So I think it starts with how do you incorporate uncertainty into your business model, and how do you incorporate uncertainty into your strategy? How does that then flow into your modeling and your budgeting? And then letting that roll into things like impairment is really important. I think my key takeaway is this: many organizations have moved away from factoring risk into a discount rate. They're actually now discounting it into cash flow scenario analysis under a range of conditions. So normally worst case scenario, middle of the road scenario, and bottom of the road scenario, and making decisions in the cash flows. The good old days we used to factor uncertainty into things like discount rates and hope that covered it, but that's not really a good indication of how things impact different line items like revenue and cost. And I think I want to encourage you that in times of uncertainty, it's probably a good idea to start heading towards actually putting numbers to these things in sort of base case scenarios, which can then actually flow into things like impairment modeling.
Yeah, great. Thanks, Kevin. Um, I thought sort of a bit of a laundry list of things I sort of add to that we've sort of seen and we've experienced and we've heard of and basically incorporated into the BDO publication. But the kind of things that you need to consider in economically volatile environments, even if not in direct impact, and I think I mentioned before, tariffs can have an impact on you, so you have to think about it. Even if not implemented, changes in tariff arrangements can't be ignored. But I agree, people are not you shouldn't be running your value in use calculation based on whatever the news come out this morning. You obviously have to take a more reasoned approach and think about the implications. But critical part of that, I suppose, is always that as you mentioned, Kevin, the idea of that process through which you go through to actually incorporate those things into your calculations. How do you do it? What what items, what information do you capture? How do you process it into an assumption, or how do you process it into a scenario analysis? Um, Impacts are accommodated in revised cash flows or revised discount rate, but not both. But as Kevin said, it's not uncommon now to see most of those things incorporated in cash flows rather than discount rates. Review the transparency and relevance of related disclosures. I think that's really important. I think it goes back to probably even the theme of this whole presentation today is the idea of actually stepping back and actually having to think about your disclosures, making sure that they're reflective of overall what you're doing, but also important of the detail that's relevant to the user to understand exactly what the connections are and how they impact ultimately the number that you're reporting. I suppose the ultimate impact is also that going concern assumption. So when that model or scenario analysis, it's obviously going to feed straight into obviously you going concern assumption calculations as well. It would also affect things like your tax if you've got DTA numbers as well.
Mm. It would be remiss of me at this point, Dean, to say that the reason why I'm also heading towards 2 or 3 type scenario analysis is because that's what you're going to do in sustainability reporting as well. Now, the scenario analysis isn't quite a financial model. It's an analysis on different climate scenarios and the impact on business models and strategy. But in concept, it's the same thing. You're evaluating uncertainty in business risks and opportunities on the business, and ultimately it all flows down into financial modeling at the end of the day. So I'm encouraging organizations to start to think like that, because their systems and processes are going to have to be built to cater for that. For climate, you probably should be doing it for uncertainty. And yes, going concern and solvency assessments will follow.
Yeah, I mean, it's also there, and it's interesting when you say scenario analysis. The thing that my mind goes straight to is the idea that sometimes um, different scenarios are not along a spectrum; they're just different. And so the idea that the idea the old way where we used to go, oh well, there's a whole range of scenarios and we'll take an expected number and an average of all of them.
Yeah,
That
yeah,
average doesn't. will not bear any relationship to the reality of any of the
Yeah,
scenarios that you've considered. So it's important to understand that sometimes that
yeah,
scenario analysis, they are separate things and you have to think about them
yeah.
separately.
I'm glad you mentioned that, and we didn't plan this, by the way, so we're having a bit of a chat now. But when you have a look at scenario analysis in TCFD and all those that underpin the climate scenario, they don't talk about they talk about pathways, and that's exactly to Dean's point. It's not a spectrum, or a
Mm.
line or a linear thing. It's actually different pathways that are kind of multidimensional, and that's that concept of pathways as opposed to, you know, weighted average outcomes. It
Yeah,
doesn't really
yeah.
work. It doesn't really work like that.
Yeah, and that it's and you know, again, going back to that issue of saying, okay, I do my revenues, I do my costs. If I'm doing my analysis, where am I ending up to, like whether it be impairment, going concern, those have on-flow effects, and so again, you have to think about the implications of it. So the idea that these are compartmentalized in accounting is not true, right? So once you pick that pathway, you have to think about the implications of that pathway. So I've listed a few of those sort of areas where the
Mm,
pathways are potentially impacted. Deferred tax, as I mentioned before. Share-based payment arrangements is a good one. You know, do you think that the share-based payment arrangements you awarded to KMP last year are actually going to be, you know, what's the effect on the number this year? Are they more or
mm,
less likely to be achieved? Things like ECL models, because if everyone else is in the same boat as you and struggling, then you'll probably find that some of the payments will come in later than you expected, and maybe they're not going to be received at all.
mm,
Lease arrangements, you might have to have a material change, but that's going to have an impact on your discount rate. Then you might have to actually think about your discount rate. So everything there's always a flow-on effect, and I suppose having a clear mind about exactly what that pathway means and being able to then
mm.
logically work your way through it. But the important part is to actually sit above it rather than being necessarily always in that detail and trying to work it out through that detail. Standards applicable for the first time. I've just, for the benefit of everyone, I've just listed them there. I've provided there's some links in the notes as well to publications we've done on them and various, uh, also in various corporate reporting insights as well. Key one there, obviously, is that amendments to AASB 101 about changing the way in which we look at current versus non-current. It's a different criteria. There's a couple of other ones. It's notwithstanding that they are sort of nichey in the sense that they affect particular transactions. I've been surprised this year about how many entities I've come across where they've actually been impacted by them. So don't underestimate the potential implications of these on the basis that they look as though they're very narrow and possibly just apply to certain things. To give you an example, the amendments to AASB 16, talking to one client recently about a sale and leaseback arrangement they're involved in, they're actually the lessor, not the lessee. And so as a consequence, I had to look at some of their lessor accounting around their sale and leaseback arrangement. So rather than giving up an asset and leasing it back, what happens was they were given an asset and they've leased it. And so very, very different accounting transaction, but obviously has implications for that sale and leaseback. Um, we'll touch across some. We'll work our way through them relatively quickly because I think we've sort of discussed them in a couple of other contexts in this media as well. Um, looking at the changes to AASB 101, if I focus there just on, I know there's a lot of material there, but if we just focus on that, the left-hand column of that diagram and think about how that impacts the way you think about your loans. The first thing you need to understand is, do you have any loans with covenants in them? And it's important to understand what a covenant is. So a covenant is something that will trigger a change in the loan arrangement as a consequence of a change in a condition in the entity. So whether it be profitability, interest coverage, debt asset ratios, debt equity ratios, various other things. Typically, it's triggered by interest coverage. Usually, it's the profit that's one that's usually causes that. The loans typically, and again, not always, but typically you need to be aware, as a consequence of breaching this covenant, what's the implication? Typically, the implication is that the entity won't have the ability to defer payment. The contractual terms will be triggered in such a way as that the lender will be able to actually call the loan, as a consequence require that it be paid immediately. Now, typically that doesn't happen, and I don't think in many respects the changes and amendments in the standard necessarily are any different than what they were previously in this respect. So it's always been that case of, if there's a covenant, then effectively if there's a breach of the covenant, then the loan typically becomes current. I think what the amendments have really tried to do is try and clarify exactly what we mean by how we assess it and exactly what the implications of assessment are. Like, so how is it that you can get a current or non-current classification subsequent to something like a loan covenant impairment, and whether or not future events and whether future loan covenant assessments are actually relevant to the consideration of the current or non-current status of the loan at this point in time. It's really important to think about those things. I think probably a probably better way to articulate the changes in the standards, probably these four key changes that I've identified here. Again, I don't think the standard has changed to the extent that we look at it totally differently, but we still have to consider things like what is the implication of the breach and how does it impact the current non-current, and also what are the implication of future breaches and future conditions. I've listed there for period of grace versus waiver. That is always a challenging discussion with people, often, and it's often not entirely clear, not helped by the standard, because the standard doesn't provide particularly strong guidance or definitions around what a period of grace versus what a waiver is. But if we take a sort of a logical, practical approach, a period of grace is usually saying you've got a period of time to sort this out, but we're not waiving ourselves. A waiver is actually a legal waiver, so we're actually surrendering a legal right. In my experience, Kevin, and you can tell me if you've ever seen it, I'd never seen, I can't say, actually, when I say never, I'll have to say I've never, that I can remember, seeing a situation where an entity has breached a covenant and they've immediately received a waiver.
Never seen that.
Yeah. Often
Not
they'll get
well.
letters. Yeah,
They'll get.
go on.
There will be a sequence of events and a significant round of negotiation,
Yep,
renegotiation, and bearing in mind when there's a breach of a covenant, the other party, being the lender, is often in a stronger negotiating position at that point. So they're not going to just issue a waiver letter.
yep,
It's just that simple.
yeah. We do often see letters provided by banks and other financial institutions which sort of allude to the idea that they might be providing some scope for relief. Typically, when you look at the terms of those letters, then they're often not worded terribly. Sometimes they're not worded terribly precisely, but invariably they don't necessarily give the same comfort as a waiver. And so you need to be really careful about that, because often we do have discussions with entities around that to say, look, the bank's given me this letter, I'm okay. Well, in fact, the letter tells them, just simply says, you've got an opportunity to fix things, but we're not actually changing the way we're thinking about it. Role of borrowers' intentions and expectations. It used to be a case that if you intended, you could roll it over, but now it's not the case. If there's no such right exists, potential for finance is insufficient for non-current classification. Meaning of settlement and impact of equity settlement. I think there was, in the past, I think the standard setters probably had a view that maybe if the underlying loan could be settled with an equity, that maybe it was non-current. But the standard at the time the standard up to this point in time has never actually allowed to do that. Whereas now the standard setters have actually changed the standard to actually say, well, now if you're dealing with particularly with an equity instrument, if there's an equity conversion feature, then that can be classified as non-current, notwithstanding it might be settled within 12 months. Enhanced disclosures. Kevin, did you want to?
Yeah, look, off the bat, enhanced disclosures generally talk about disclosures related to covenants and the risks of those covenants being complied with or changing after first of all, after year end, they will actually change the classification that you've made at year end. That is quite important. Can't quite remember offhand what all the requirements are, but I do remember being struck by the concept of risk crawling into the covenant disclosures.
Yep,
In other words, a risk of, meaning something happens after year end that
yep,
is not reflected in the classification. That's sort of the key takeaway that I took on the enhanced disclosures, which
yeah,
brings
fine.
me back to my original thing at the beginning of the year, is that the accounting does actually reflect the commercial reality a lot more than you think it does,
Yep.
because we're not talking about conditions so much as we're talking about risks that conditions change that affect the change in the classification.
Yeah, no, spot on. Because one of the key issues that standard setters were dealing with was this idea that there could be a condition in the future that has to be met, but at the reporting date it's not relevant. But it looks like it might actually be breached in the future. And so some of the disclosures, new disclosures, are really addressing that issue of saying, well, it's not just a set and forget, or it's not just a cut off. Yes, we make the assessment at reporting date, but if there's something in the future lurking, because it's probably been one of the key issues that standard setters are having to deal with, is that at reporting date something is classified as non-current, and then 2 months
Yeah.
down the track it becomes current because it's actually breached.
We actually got a question, Dean,
Mm,
it actually goes to this question of, does an entity now need to disclose how they fulfill every covenant at the reporting date? What if there are multiple covenants? Will the entity need to disclose status of every one of them? I mean, off the bat, no,
mm,
there's not a requirement to disclose every covenant,
mm.
and how you fulfill them. As we've mentioned, there's disclosures around, especially around risks of covenants changing the classification. That's kind of one of the key ones. There are some others, but there's certainly not a blanket. You have to make disclosures on every covenant at balance sheet you
Yeah,
have you complied with. That's definitely not
yeah,
the
no,
spirit of the arrangement.
no. You'd hope materiality would sort that out for you as well. Like you'd expect
Absolutely.
that to be one of the key features.
Mm.
So there's a video guide. It's quite a good guide. It actually talks about the different scenarios, gives some examples to actually demonstrate how the new requirements work.
Yeah.
We'll skip through a few of these. Lease liability. I think the key one with this is that if you are, and I've mentioned before that we are seeing sale and leaseback arrangements between where it's the lessee or it could be the lessor. The fundamental issue that was the standard setters are dealing with here is that if you go from you own a let's say we own an asset, we sell the asset and we lease it back. Let's say it's a retail outlet. It's not uncommon to find retail outlets have lease arrangements that are turnover lease to lease payments. And so as a consequence of bringing that lease onto your books, if it was all entirely turnover lease and that was the liability, you get a very weird mismatch in all of the journal entries. So normally you think about a sale and leaseback. I own the property, I sell it, so debit cash. But if I then enter a lease, I get a liability as well. So there's a financing component. And then I actually de-recognise the asset that I had as an owned asset, and I recognise it as a right of use asset. Now you put together all those numbers. The difference there is the gain and loss on effectively on sale. You're only selling that portion of the asset that you're effectively giving up as a consequence of the lease. But if you have no lease liability number, then it makes your gain or loss on that look really strange. So what the standard setter said, okay, let's fix that by simply saying, look, normally we would not include turnover lease in a lease liability, but in this situation, then you actually need to include the lease liability number with the turnover rent in it. Otherwise, it just doesn't make any sense. It's not going to work. Supply finance arrangements, again, this one, again, very niche, very specific, but obviously if you involve yourself with an arrangement whereby you're trying to match up your cash flows and ensure that you can mash up your customer and your supplier payment arrangements in a better way, so introducing a supplier finance arrangement into it, it then becomes a question of what exactly is happening. So how do we classify those cash flows in our cash flow statement, but also how do we classify the liabilities associated with that? So previously, we might have owed a supplier money. Now we owe a bank money or a financier money. Is it gone from trade payables to a loan, or how's it actually moved? So, in accounting terms, it's more to do with perhaps presentation and actually disclosure. But it's an important thing because it actually has been quite a significant area that standard setters have. They've been prodded effectively by, I think, probably user groups to actually sort of consider how this is going, because I think there's a few user groups out there that were looking at the financial statements of entities, particularly retailers and those types of entities, saying, look, we're not really getting we know these people are involved in supplier finance, and we're not quite sure what's going on. So, how can that information be better demonstrated within the financials? Fair value measurements for not-for-profit entities. Look, this is obviously specifically applicable to public sector entities. The one thing I would say is that, and I'm going to go out on a limb, but I can't remember. But Kevin, you can correct me if I'm right or wrong. Off the back of all the discussions about the application of IFRS 16 and AASB 16 to not-for-profits, and particularly public sector entities with peppercorn leases, there was a whole lot of discussion around how to fair value leasing, the lease assets. And that seemed to me to generate a whole series of discussions around actually, and it almost reignited the discussion around fair value measurement under AASB 13 by public sector entities. So my understanding was that this is really sort of as a response to a lot of that discussion around, look, public sector assets are often very distinct. Public sector entities are required to fair value a lot of their assets, but it's a real challenge to do it under an accounting standard that was written for for-profit entities. And so as a consequence, things like there's lots of restraints and restrictions and expectations around the use of assets. And as a consequence, this is where that sort of the impetus for this change has come from. Is that, I don't know if that's a fair articulation?
It certainly was one of the key things that started it off, was the leasing question. I do think, though, that it was probably something that was a rollover from when the IFRS or AASB 13 came out to begin with, because the standard was never written for the not-for-profit or public sector. It was written obviously for private companies or um, private
Yeah,
entities
yeah, yeah,
operating in a market where there's enough tension between buyers and sellers, and highest and best use is easy to interpret. So yes, they certainly started there with the leasing and trying to close off some of those avenues. They also have dealt with things like service capacity and potential of an asset, which really used to be there. And then I think we lost it when IFRS 13 came in. And so we've kind of put it back, but made it new and fresh for the public sector as well as the not-for-profit sector. So yeah, they've certainly dealt with a number of issues along the way. And then I do think they've actually locked in as well the concept of current use being deemed highest and best use, which I think is up there.
mm,
They've set criteria about when that's deemed to be the case, because that wasn't clear either. So certainly leasing was the impetus, but I do think they've kind of rolled up a whole bunch of other issues that the public sector and not-for-profit sector used to struggle with, and kind of, let's say, an omnibus of concepts have been made fresh.
yeah. No, you're right. I think when we introduced AASB 13, there was a whole lot of amendments to AASB 116 around property, plant, and equipment, and those requirements. Lack of exchangeability. This is probably not a new standard necessarily. Well, it's a new standard, but I suppose I wanted to highlight this one. Normally we wouldn't talk about this one, but we are actually seeing on occasions. There are some currencies out there that are not readily exchangeable, and so as a consequence, in dealing with that, some of the standard setters have actually sort of looked at this and gone, actually, what we need to do is actually make some guidance. And what they've done is actually simply said, and this guidance is quite straightforward. You actually have to estimate the spot rates. Now, that might involve you doing some work around currencies, but the fact that something is not necessarily readily exchangeable doesn't necessarily mean that you can't then prepare your financials. Now, lots of things we estimate, lots of things we have to determine, based on a calculation of a determination. This is just another one of those. So I just wanted to highlight that because, notwithstanding we might or might not see a lot of it, it does pop up from time to time, so be aware of it. Recent IFRIC agenda decisions, I've given a summary there of the ones that have occurred probably in the last 12 months that are potentially relevant. Again, probably the key one that we see as most relevant to our entities is around the operating segment disclosures, and I might just focus on that one. The IFRIC agenda, or the IFRIC received basically a question from constituents some time ago. I think it was a couple of years before the July 2024 determination. But the questions they received were effectively those three questions. So, is the entity required, or is an entity required to disclose for each reportable segment amounts for items specified in paragraph 23A to I? If those amounts are not viewed separately by the chief operating decision maker, is the entity required to disclose for each reportable segment material items of income and expense that have been disclosed elsewhere? And how do you determine if an item is material in IFRS 8? I suppose the key issue that the person sending the question was trying to understand was, how do I interpret materiality in the context of a set of sub information within a note of a set of financials? I can do materiality at the financial statement level, but it becomes more complicated at the operating segment disclosure level, because am I interpreting it at the group level, or am I determining it at the segment level? The IFRIC were pretty, it took them a while. They sought feedback, but they actually got some good feedback from constituents. And in response to question one, yes, disclosure specified amounts are either included in the segment measure of the P&L reviewed by the CODM, or provided to CODM even if it's not included in the segment P&L. So even if it's not separately included in that number, if it's a part of that number, then you need to disclose it as a part of those operating segment disclosures. Their second response was really around, and it wasn't entirely, definitive, but it's saying you actually have to apply some judgment. So it's not easy for the ISB to necessarily look at every situation and give a determination on every situation. But what they did was they actually said, look, you need to apply judgment, and you need to consider materiality at the segment level. We have, when I say we, I mean BDO Global has issued updated model financial statements, and what they've done is responded to that by demonstrating in those model financial statements how maybe somebody might apply the IFRIC determination in this context. The example is, in this case, was as an entity that was actually producing toys, and so cost of goods was a big part of their expense. Previously, they didn't necessarily disclose the cost of goods sold, but they decided that maybe as a segment note disclosure, it would be relevant to users to understand that cost of goods sold number. So inserting that as a part of the individual line items that are there within the operating segment disclosures. It's a case-by-case situation, and certainly it's not something that we're saying that in all situations an entity has to insert cost of goods sold. A good example might be where an entity has two segments, and one of the segments is a reseller and the other segment is a manufacturer. You wouldn't expect to see cost of goods necessarily, or even employee expenses in the reseller's accounts. You wouldn't expect to see material amounts anyway for the reseller, but in the segment that's actually manufacturing items, you might expect to see those. So again, thinking about the materiality at the segment level, what do you think users understand that those segment level reporting performance? Kevin, did you want to add to anything to that?
I think you've done a great job. Well done.
Oh, thank you. Touch on hyperinflationary economies. Again, not something we necessarily think about, but I'll tell you what, we've actually had a couple of scenarios where entities have prepared consolidated financial statements, and when we've looked at the list of the subsidiaries, a couple of them pop up as being operating in jurisdictions which are hyperinflationary. So the question's then asked, have you applied AASB 129 to those? And if you have, how is it done? So it's important to keep in mind, and if obviously all of your subsidiaries are not operating in any kind of environment where there might not be hyperinflationary, then you're relatively safe. But be aware that there are obviously entities in hyperinflationary economies at the moment. It's also relevant to note that they can move in and out of those things quite easily. So things can happen in those jurisdictions whereby, and a good example is you look at that table, Zimbabwe actually was a good example. So it started off as hyperinflationary in 2023. It ceased to be hyperinflationary in 2024, but the expectation is it potentially might be hyperinflationary in future reporting periods. So entities with overseas subsidiaries that are operating in these types of jurisdictions just need to be aware that the hyperinflationary aspects can change over time. Which now brings us to sustainability. Kevin, can I hand over to you on that?
You can, Dean. That's a wonderful time you've given us. That you give me 30 minutes for sustainability, so I'm sure I will fill it. I will just kind of jump with one question that's still related, shall we call it, to the IFRS reporting, and that was on whether there will be training or webinars on IFRS 18. We haven't really dealt with that today because it's not effective for the June 25 reporting period, although it is coming down the track, and obviously there's quite a bit of work to do behind that. And the short answer is yes, we are doing training and webinar on IFRS 18. There will be more in the future, but we've actually already done one in December 2024. So you can pop on the website to have a look at that. I think it was actually part of this webinar series, so you can just look in the history. You should find at least an hour-long session. I'm almost sure it was a letter and I, but there certainly was somebody else with me when we did it. There will be many more of those coming in the lead up to that standard on new presentation and disclosure. We also have an IFRS 18 page on our website, topics page, where we have a number of other resources, and one of them is a monster 108-page guide dealing with this new topic. And I actually think it's the first of two guides that are coming out. I think there's a second one to follow, so keep your eye out for that. All right, so let's jump into sustainability and sustainability update. Now, we've got a lot of content out there in terms of mandatory sustainability reporting, and I wanted to not repeat it in a way or format you've seen before. And since this is preparing for June 2025, we thought we would do it in the concept of top 10 things to think about, top tips to get you ready. We're giving you 10. Not everybody's reporting at June 25. In fact, I'm not really sure anybody's reporting at June 25. The first series of entities who will report will be December 25. They're already in their year, and the June 26s are about to enter into their first year from 1 July. So everyone's starting to come online, at least in the Group 1 phase. So let's do top 10 top tips to be ready. And at a high level, what you really want to be doing right now in preparation for June 25 is getting your organization ready for this. That's really what you should be doing for now. Preparing your normal financial report or your normal annual report for 30 June 25, but starting to actually lay the groundwork in the organization for the mandatory sustainability report. The first thing you want to do is make sure you understand what your mandatory obligations are. Now, with mandatory obligations, there are lots of obligations for an organization to do various forms of mandatory sustainability reporting. We talk about workplace gender equality reporting, and we can talk about modern slavery reporting. All those are, by definition, mandatory sustainability reports or reporting obligations. But the key one we're talking about here is the mandatory obligation for corporations under the reporting under Chapter 2 of the Corporations Act, which is the very first question in our decision tree, who are required to, in future, lodge, along with their financial statements, a mandatory sustainability report, which focuses currently on climate as part of their annual report. You need to understand this, and boy, have we run into all sorts of variations about exactly who has to report and when they have to report. So that's the first thing you want to do. And I would say you want to do it before June 25 so that you can actually start to put a roadmap together on who's going to do this. This is a decision tree. We've thrown this out there. It's on our website a lot. The first two questions really are about which entities are required to do this. And then after that, the questions really are when do they have to do it by, which is kind of how we put this decision together. But at a high level, if you're an entity lodging a financial report with ASIC as required by Part 2M of the Corporations Act, you are most likely at least captured in the regime. There then is an opportunity that you might not have to actually do the report because somebody else in your group structure does it, like a parent. But first and foremost is if you're lodging a financial report with ASIC as required by Chapter 2 of the Corporations Act, the regime may apply to you in some way or form. And as part of our top tricks is you should probably solve that today. Interestingly with this is that the when questions are driven by things like, are you a registered scheme? Are you an ENGA reporter? Or do you meet two of the three size criteria, being consolidated revenue, consolidated assets, and your employee number? There are all sorts of complications around how to determine those things, revenue, gross assets, and employees, including how to interpret, for example, whether part-time and casual employees are part of the measure. But the most important thing is that the test is done at the end of the reporting period. So you might only end up knowing which group you report under, in other words, how soon you have to report, at your year end. And you don't want to be caught out by things like suddenly you hired a whole bunch of people at the year end and now you meet one of the hurdles and suddenly you have to produce a mandatory report. The most important takeaway from this one is to start to get your organizations to realize, first of all, when they have to report, but also to start to communicate through the organization that a mandatory sustainability report, which is really climate in this case, has to be prepared and lodged along with the financial statements within 3 or 4 months of the year end, in accordance with whatever your lodgement period currently is for financial reports, and it has to be subject to assurance by the auditor in the same period. And that means a lot of work not only has to be done to prepare the report and all the supporting information, but it's also got to run through the reporting process and the assurance process with your auditor all at the same time that you're doing your normal audit at year end. And that's quite a big structural shift for a lot of organizations to grapple with. And that's probably the key takeaway or the top tip to realize at this point. So if anything, if you're a group one entity with a June year end reporting for the first time, let's say in June 2026, your question for this reporting period is, could I run with this report this year along with my financial report and my audit? And if I can barely get my audit for my financial report across the line at June 25, it probably means you're going to struggle to get the mandatory sustainability report across the line in a year's time, and action should be taken. I think I'll leave it at that. Next slide is then what the composition of the report is. We've covered this in many slides and webinars and publications, and you will see that the sustainability series of webinars that we spoke about at the beginning of the session follows this format. You know, there's governance, strategy, risk management, and metrics and targets around climate or climate and emissions. The disclosures are vast. We're not just disclosing numbers, we're disclosing actual quantitative and qualitative information around governance processes related to climate risks and opportunities, climate risks and opportunities themselves, along with things like scenario analysis and impacts on financial prospects, how that interacts with the risk management processes in the organization, and then a whole bunch of things that relate to metrics and targets that may be used not only in terms of your carbon emissions, but also in terms of how you monitor your targets towards, you know, targets that you might have set in the organization. This is so much more than anybody's ever had to produce before. And this is where we refer back to the OFR. There's a bit of OFR going on in here in terms of physical and transition climate risks, but then we're actually making disclosures around governance processes and risk management processes and so forth. And this does not only apply to listed entities. This applies to any company that falls within the regime that is reporting under Chapter 2 of the Corporations Act. So everyone is really covered that's lodging a financial report with ASIC. I guess the top trick for my number one out of my top 10 things is make sure you understand how and when and what applies to you so you can start to make amendments on it. I did get a question which actually I've held on to, which came up earlier in the webinar, Dean. It said, do you have mandatory obligations for sustainability reporting at a global level covering more than just Australia? The answer to that is it depends, but mostly no. This regime covers companies probably at the top of the Australian corporate structure, lodging with ASIC, but that doesn't mean a company isn't subject to some level of reporting obligation somewhere else in its global structure. Most companies and most regions of the world, let's take the Europeans, for example, have their own reporting regime for corporations at the global level. So this one I'm talking about is really just the Australian regime. If you're lodging an Australian report at the top of an Australian corporate structure under Chapter 2 of the Corporations Act, it covers that group structure up to that level. But you may be covered by more than that in your global structure in another country or through another reporting regime. Dean, anything to add there? Kind of did. Nope. Take it as no. All right. Number two, top tip for number two is define what and how you are addressing your sustainability report. And I think this starts to head towards road mapping or what needs to be done. I put a slide together on the next slide just to kind of show you the overview. It starts to unpack the governance, governance strategy, risk management, and metrics into a sort of a different format. And it starts to outline some of the journeys that organizations are going to who are only just starting this out, but who actually have a very early reporting requirement. So we're talking about group ones and some group twos. They haven't really been doing anything to prepare for this in the past, so they're suddenly on the trot a bit, but they're going to be reporting quite quickly on it. And not that I'm saying this is all organizations' roadmap, but what generally starts to happen when organizations pick this up for the first time, they really start with understanding as a first step their preparedness for this. In other words, what have they got? What is a climate risk and opportunity assessment? Often at the enterprise level is the first instance. And then also they start with carbon emissions boundary calculations. And if they've been doing carbon calcs in the past, they do some sort of assurance readiness. Those are perhaps the big three steps. They will get you started. And then you can move into things like climate scenario analysis, financial impact analysis, strategy and resilience testing, and then starting to develop a reporting template and start to bring all your disclosures in. There's a lot more than this to disclose. Things like governance and so forth, but this is at least how to unpack it in a way which will help you define what and how you are addressing your sustainability report, it'll start to unpack things. And generally what happens as you identify what your climate risks and opportunities are and you start to do your carbon emissions calc, other things start to trigger down the path and it'll allow you to mature. Um, all right, so that's maybe a kind of a bit of how to approach it. Third step then is to get the board on board on the next slide. Now this one here is, you would think self-explanatory, but it's dawned on
Oh,
me
no.
just how hard it is to take the leadership of the organization with. There is a tendency for organizations to say, okay, this is coming, we'll give it to the financial controller and maybe the CFO, and then we'll see you all, when we're back from our leave in July. Hopefully we'll have a draft at that point. It really is important for boards, and I guess we also include audit and risks and other parties that are part of the governance structures to really understand what's required here. This is building an entire new reporting regime, plus processes, controls, and so forth, integrating it into the organization beyond just the finance team, and actually appointing a sponsor or a czar at the top who's going to actually essentially sponsor this process. So normally somebody on the board would be the sponsor of this process. Sometimes we are dealing with group one companies who are reporting at the end of the year and we're still doing board presentations as education pieces to the board. That's fine. I mean, any form of education to the board will help them understand what their responsibilities and roles are. But the reality of it is this can't be done without board sanctioned approach, and it often means that boards need to sign off on budgets. One, to use external consultants because it's not something you can necessarily do by yourself, but also to get the boards to essentially start to pivot how people are assigned responsibility within the organization. You can't add onto people's already busy jobs the obligation to get ready for this. You actually need to make strategic decisions about who's going to be doing what and how they're going to do it in accordance with their normal day-to-day functions that they're already dealing with. And that can really only come from the top. So you need to get the boards involved in this. And I do want to reiterate again, this is not something you do in the last 2 weeks of the year. It actually is a business process re-engineering activity that requires essentially investment in resourcing and capability to get it off the ground so that you can actually generate this report for auditors by the end of the year, all at the same time that you're lodging your financial report.
Everything,
Any comments,
everything you
Nadine?
just said, I was going to say everything you just said resonated perfectly with me, but in the context of my standard setting experience, I remember working, I've been working at the AASB, and then we did projects for the ISB as well. And one of the things that we realised, if you want to get something off the ground, you need a board champion. If you don't have a champion on the board,
Mm,
it would be very unusual to find a board would be so unified and clear in its individual board member and board
mm,
entirety's responsibilities to be able to actually undertake a project like this
yeah,
collectively. It just doesn't work like that. So
yeah,
yeah, no, getting the board on board, absolutely.
yeah. Right. Thanks, Dean. And I mean, you and I share, we're spirit animals when we come to this. It can't be done without leadership from the top.
Yeah.
Investing in education and knowledge transfer. At some point, the people you're talking to on the board, as well as the board champion or sponsor themselves, need education, but you also need to flow that through the organization. Everyone from operations, from finance, from sustainability, even from supply chains and procurement will be involved in this at some point. And they probably need to understand, one, what we're trying to achieve so that they can then actually understand what their role is. It doesn't help when you start running to somebody, and we see this in the carbon accounting a lot. We start running around gathering data from the procurement or supply chain people, let's say procurement, and they're like, well, why do you need this? First of all, what's its purpose? And then they get all protective and get all excited about the fact that somebody's kind of trampling on their turf. Um, so not just the technical education, but also then essentially the operational knowledge. What are we trying to achieve here? How is this going to work, and what's your role in that process? And you can see now already why we're saying, even if you're not reporting for June 25, which is what we're talking about today, you can see how we're really trying to set ourselves up for December in 25 and June 26 and so on. There's a lot to do here, which leads me into point number 5, which is develop a roadmap. And we've been putting these roadmaps out there for some time. I've put two examples for you here, which is a group 1 and a group 2 roadmap, depending on when your starting point is. But it's another version of essentially planning forward and how you're going to do it. Under point 2, when I gave you a first steps in a maturing kind of, what do you do for climate risk opportunity and emissions boundary? It's essentially another way to represent you've got a lot to do, you've got to unpack it. It can't be all be done in 1 week. It probably can't be done in 1 month or even 3 months, and actually roadmap that from now till when the first report will be generated. And then the board can take responsibility for that and start assigning responsibilities and budgets accordingly. Key things I want to kind of put out here is we generally start with carbon footprint measurement as a separate stream, but that is actually about data. It's about boundary setting. It's about data processes and data security and accuracy and completeness. And it's also about making it assurable. The carbon measurements, scope 1 and 2, are one of the first components that are going to be assured by the auditor. So you essentially need to treat that like any system of any system producing financial and non-financial information that's going to be subject to an auditor. It really needs all those things: controls, processes, documentation, audit trail, judgment setting, and so forth. Kind of leave it at that and move on to the next one, which is assigned responsibility. I think we've spoken about the board and a board champion, and we've also spoken about everybody's going to do something. But at some point, you actually need to assign responsibility for operationalizing this. I think that makes obvious sense to organizations. But the message I would have thought, yeah, I would put in place for you is the use of consultants. Um, I think at some point you're going to need to use a consultant, and you might end up using multiple consultants. I don't think it's necessarily that only one organization could assist. This is once again just showing you the sorts of things you might consider bringing someone in to help, especially if you don't have the skills and competence in the organization to do this. There are provisions in the standards about um, uh, doing the best you can based on the resources available to you. I've paraphrased that, but that doesn't mean you can't actually go and find those resources if you have access to them. And having access to consultants in the market um, is an option you will have to explore. It's not enough to say, I just don't want to do it because I have to involve outside people, so we haven't done it. It doesn't really work like that. And generally, where we see most organizations reaching out to us are in the strategy and the metrics and targets bars. First and foremost, it's not the only thing we do, but generally, when you start with climate risk and opportunity first, and you start with your carbon emissions boundary and data gathering, those two things will then set things off for the next thing and the next thing and the next thing. And what you can also do is then budget for this over 18 to the next 24 months about how you might use and spend that budget on bringing some expertise into the organization to get it across the line. Remember, the auditor has to audit this, so you need all the help you can get to build those. Next slide then is moving to start measuring your carbon footprint. I think this is obvious, and Aletta and I have drunk the Kool-Aid on carbon measurement a long time ago. And the reason for it is it's something that a lot of people, especially in operations and finance, can tangibly understand because they can build a process around it and a data gathering strategy around it. But there are some nuances that go with it about breaking down different types of emission gases, understanding value chain, and then going from there. So it is a good place to start if you want to mobilize your forces. But it is true that this information also has to be assured in the first instance, and it also helps that often this then allows organizations to progress to things like target setting and actually just sort of coalescing around risks and opportunities. So it is a good place to start. And I have put up there then on the next slide, Dean, our approach to measuring carbon, a 10-step approach. We use this in our masterclass. So forgive me for once again putting the masterclass that we've advertised earlier on the agenda. We use this as our masterclass, but it also then allows us to build what we called an auditable trail that you can hand to your auditors so they can assure it, because our 10-step approach not only covers what you have to do in order, but it also builds documentation and systems and processes around it so that you can essentially then build your audit trail from an audit point of view. Starting with the most important things at the beginning is why you're doing this through to boundary. And by the way, notice that we don't get to data gathering until step 5, maybe even 6. 6, there it is, sorry, 6. If you're starting with data before you've done the other steps, you're most likely going to do something either inappropriate or you're going to get your boundary wrong, and you may even be gathering the wrong data to begin with. So data is really important, but data is only step 6 along the way in order to measure this properly. Right. My eighth step is understand what assurance ready really means. I actually have 2 messages here. The first one is understanding what assurance means in the context of what your auditor is going to do. So the auditor will not assure everything in the first year that you disclose. You are still required to disclose everything in the first year that this applies to you, but your auditor will only assure select components of it, and that's limited in the first instance to governance, strategy, risks and opportunities, and scope 1 and 2 emissions. It's limited assurance, not full reasonable assurance, similar to an audit. It's more like a review that half-year accounts would be subject to, but it has its own standard that's been developed globally, which has been adopted in Australia, and the auditor is going to have certain requests. So I guess what we're saying is engage your auditor along this journey really early on, because they're going to have
Yep.
demands of this. But I will actually also say that assurance ready isn't only an auditor assurance, it's actually what the directors are required to do. Directors are required to take responsibility of this in a director's declaration in your annual report, similar to the way you do it in your financial report. What's interesting about that is that in order to do that, the directors have to be assured that the information systems of the organization are producing the right information for disclosures, and it's complete, accurate, and it's got some sort of control environment around it. So assurance before you get to auditor also means assurance within the organization. It should be a information system generating a report that is subject to the control environment and subject to audit and risk scrutiny, as well as director oversight. That is what it means first, before you hand it over to the auditor for independent limited assurance in the first year and thereon. This does build up to a full reasonable assurance report over time, but in the first instance, governance, risks and opportunities, as well as scope 1 and 2 emissions. Didn't you have anything to say there? Because I know that assurance gets your juices flowing sometimes as well.
Oh, literally everything you said, like, and the engagement with the auditor early, like actually start to talk to them. What are you doing? When are you going to start doing it? And like an ASIC, they're a source of information. Tap them.
Yeah, good stuff. Last 2 is consider data and technology considerations early. I would lop this into when you're building your roadmap and you're starting to allocate responsibility for this to people and individuals, and you might use external consultants, you should probably also be considering the use of technology. To me, people, consultants, and technology and data are just resources in different ways and forms. So don't leave the data out. It's not an Excel thing. You could probably get away with Excel for the first couple of iterations, internal iterations, but by the time you're actually getting to publish information publicly, especially when you get into things like scope 3 data for emissions, as well as other diverse and global organizations, will probably need to adopt some sort of ESG type technology or technology to kind of keep this all, documentation flowing. And then finally, number 10 is beware of risks of greenwashing. This is an interesting one. I think everybody understands the concept of making claims that don't meet your environmental credentials. I think that's going to become quite difficult now that we're actually putting information in an annual report subject to a director's declaration, which, by the way, has a penalty attached to it. Directors can find themselves on the hook for, I think it's something like $1.3 million in penalties and fines for inappropriate director's duties over this mandatory sustainability report. It also has to be audited by the auditor or assured by the auditor. So I think what we're finding is saying things you're doing or not saying things you're doing in terms of greenwashing, just like making disclosures in your financial report that are either hidden or obscured or not quite truthful in terms of your financial report, is going to become so much more important. It's not just a regulator with a big stick anymore. There's actually a criminal and civil penalty regime behind this now that will start to creep into the way ASIC regulates that. So that is my top 10 items. We did have a couple of questions and we have a minute to go, and I think I will actually deal with them quickly. We did have a question on, do listed Australian companies who do not meet size threshold number 3 have any mandatory sustainability reporting obligations? The question is a good question. The regime isn't about listed entities or unlisted entities. It's about whether entities meet any of this criteria in there. There's a size threshold, there's an emissions threshold, and there's an entity or asset holder threshold. There's kind of 3 thresholds. But the reality is, if you end up at the end of the decision tree and nothing applies to you, which I imagine is possible, you wouldn't have a mandatory sustainability reporting obligation. It would intrigue me how you got there if you were a listed entity. So I'd wonder how you got there. But the reality of it is if you don't meet the thresholds, there isn't an obligation, but you do need to work through all those thresholds. It's not driven by whether you're a listed entity or not. It's driven by whether you meet one of the 3 sort of thresholds: size, asset holder, or emissions. It does talk about if you're a New Zealand entity, ASX listed, would this apply? Well, I imagine if you're an ASX listed and you're reporting under Chapter 2M of the Corps Act, probably yes, but I'd imagine we'd have to look at your unique situations to understand if Chapter 2M is what applies to you. And there is a comment here which we'll take as a comment about, do we see a scale back happening globally and ultimately in Australia about this? No, we don't. It is possible that things can change, but the reality of it is we are not anticipating a scale back per se to flow from Europe. I think if there was a scale back, it would be for other factors that are Australian specific, but that hasn't happened, and there's been no indication from government that that is happening. So with that, Dean, I guess we will say that thank you for your attention. We have splashed on the screen while I was talking who our IFRS and corporate reporting leaders are, as well as links to our various education material. And Dean, thank you for a wonderful session.
Well, thank you, Kevin. I really enjoyed it. Hope everyone got something from it, and speak to you also very, very soon.
Thanks very much. Thanks, Dean. Goodbye, and goodbye, everyone.
Thanks, Roman. Bye.